I'm recording. So, we're being recorded. All right, guys, so let's get back into what we're doing. I'll summarize, talk about your weekends, and then we'll go from there. Now, with respect to Chapter 1, you guys know it's here really for historical reasons, but it does play into what we're doing in terms of you really should read it. You're not going to be directly tested on it. Chapter 2 deals with gross income, this concept that income is very broad in nature and that virtually any accretion to wealth is subject to tax, including, for example, income earned overseas. So you got to include everything. Unit 3 deals with the fact that notwithstanding originally we say that all things are includable in income, we learned that that's not quite true and that the code has several exceptions to our general rule, right? And we have code sections that spell that out. In particular, that's spelled out, Arish, what code section? What code section deals with gifts? Kyle? What code section deals with gifts and bequests? What? And what does it say? Right? Gifts are not generally taxable, but it's subject to some exceptions, right? Yes. And Doug, those exceptions are. By the way, again, I need your placards out. So if you have it hidden, that doesn't help me, it doesn't help you. So are all gifts not subject to tax, Doug? You got to talk loudly because there's people like Raquel who can't hear you down there. But are you saying that all gifts and bequests are not subject to tax?
102C says that gifts from employers to employees are excluded from...
In the employment context, right? In the employment context, 102A does not apply, right? And Bill, bless you, but having said that, what code section then makes it taxable? Bill? I'm looking. Oh, Gary? I'm getting confused.
I'm sorry. Yeah.
Bless you too, Gary.
Thank you. I'm sorry, what was your name?
If it's not, if 102A doesn't apply because of 102C, what code section does apply?
61, right?
Code section 61, right? Makes it taxable. All right. And then we looked at not only code section 102, chapter 4, we looked at employee benefits, right? And we said that generally employee benefits are subject to tax under code section 61, and our fringe benefits generally subject to tax are generally our fringe benefits run subject to tax. What? You got to say it loudly.
No.
They're not subject to tax. And would you agree, Chris?
Yes, I would agree.
I hear a disagreement. Jenna?
No, section 132 gives a fringe benefits exclusions, which are not subject to tax. There's about 7 of them, but all the other fringe benefits.
What's your authority to say that fringe benefits are generally subject to tax?
61.
Code section 61, right? Regulation 61-21, right? So, Chris, Ron, they're subject to tax, except if it falls within the scope of 132, right? That's a very important bias, right? Because if you tell your client, oh, generally not subject to tax, it's not a good way to start the conversation if that's not true, right? So 132 lists exceptions. Now, aside from code section 132, the authors discussed meals and lodging shoo you from being not subject to tax. What has to happen for those meals and lodging not to be subject to tax? Are all meals and lodging shoo you not subject to tax? John? Has to be a condition of your employment, right? Meals and lodging, and they have to be actual meals and lodging, right? They can't be groceries. They can't be other things, right? Now, among other things, just as a segue, last Wednesday I went to a lecture entitled something like How to Write Like a Nation's Top Advocate. So, and again, verbiage here, I've said to you, even though this isn't an English class, words are very important in tax. And to highlight the importance of that, during this lecture that I went to on this past Wednesday, there was a court case a few years old talking about in a strip mall, a Panera's had opened up, and in the Panera lease language it said that in this strip mall, no other sandwich store shall open, okay? No other sandwich store shall open. Having said that, any fans of Qdoba here? All right. And the question was, could Qdoba open here? And what did that case turn on? Yes. What is the definition of a sandwich? And is a burrito a sandwich for those who saw my email? Right. And who wins? Qdoba can open. So the use of language is very important because Panera, I'm sure, was not too happy with a Qdoba opening up next door. But what did the authors of the decision have to do? They had to write down that the authors of that decision had to look up the word sandwich and see that it's generally 2 slices of bread with some protein in the middle. And a burrito is not 2 slices of bread with a protein necessarily in the middle. All right? So the importance here of using words as you would use them in common language. So if someone gives you a bunch of groceries, may not constitute meals. I just want to say some other pointers for writing, because I see this all the time, that I'll share with you. You don't have to attend that 3-hour lecture that I went to about good writing style. I didn't know that Word has a feature that allows you to measure the average length per sentence. Did you guys know that? And what is the average length per sentence if you want to write and write well? What do you think the average length per sentence should be? Should be 25 words or less. Okay? 25 words or less as a general rule. The other thing that I've seen that I want you to shy away from if you can in your writing that I think is a big problem, block quotes. How many of you have seen people when they write, they cut and paste big block quotes into what they write? And what do you feel as a reader when you read a big block quote on the part of the writer?
I just skip it.
You skip it. And you say, mentally, if you don't, I'm sure you do, say that writer was lazy. Or you may admit, because you're not going to look at yourself and say you're lazy, right? No one wants to say the reader is lazy. So the point is, when you're writing for your supervisors, if you get into a habit of stringing a bunch of block quotes together, that's fundamentally flawed in terms of your writing, okay? I use a block quote every once in a while when I write, if I consider the quote very important, but generally shy away from that because that is a sign of your laziness, all right? And you're not going to, no one's going to say this is a great memo you put together if you just string together a bunch of block quotes. And then one or two other points made. How many times have we seen people say there are several reasons why the taxpayer should win here? And what this person said. Instead of using the word several, say there are, say, 3 reasons, and then the reader anticipates the 3 reasons, or there are 2 reasons. This way, the reader doesn't have to guess how many reasons are make the taxpayer's position compelling. So just stylistically, some things that I will share with you that I picked up. Chapter 6, let's just summarize hopefully what you guys picked up in Chapter 6. I said it was an important chapter. We looked at one half of this. The pivotal code section here, Patty, is what? 1001, right, Patty? And what does 1001 say? Just paraphrasing it. How? What does it say? Pretty? Okay, amount realized less adjusted basis is gain or loss, right? And for gains to be taken into income, Matt, what do you have to do?
You have to get the realized value.
You tell me, what 2 things to take it into income do you need? It must be realized and it must be recognized, right? For gains to be taken into income, they must be realized, they must be recognized, right? And with respect to losses, you know, what do you need? You got to talk loudly even though I'm right here. I agree it should be realized. Anything else, Arish? Realized, recognized, and allowed, right? So Arish, you're on a roll. What code section permits you allowance? Liz, what code section? This is one you got to know, right, Joe?
Yeah.
What is it?
I'm sorry, I was writing out. What was the question?
What code section opens the doors for allowance? Jing Jing beat you to it. She just got the client. You lost.
65C.
165. Well, that's for individuals, but so certain losses, for example, when you sell your home, Jack, when you sell your home, can you take that loss? You bought your home for $500,000 and you sell because the market's depressed for $300,000. Okay, very common, right? You bought your house in Florida, picture if you will. All right, you bought it for $500, you sell it for $300. Can you take that loss, Jeff? Jamet, can you take it? Jamet? How? How 2? How 1? Can you take it? Emmanuel, can you take it? What? But a lot of people say they bought their house as an investment. Does that sway you, John? Or do you stick by Emmanuel and say the loss is disallowed? I've had it for 5 years, 20 years. You tell me in the code, does it make reference to how long you've held the house for? Doesn't matter. Doesn't matter. MJ, does it matter? Doesn't matter. Does that mean you get the loss or not? You get the loss. It's allowed, you're saying. Anyone disagree with MJ? Justin?
I disagree, but I can't say for
Bill? Gary?
Not allowed under 165C.
It's going to be disallowed under 165C, Emmanuel. You're right. Even though someone calls it an investment, does that make it an investment? That self-serving label? Why are you living in your house? What's your primary reason for living in a house, guys? Excuse me? Shelter. Okay, shelter. A personal reason, right? If it's an investment, it's only secondary, right? Do you get losses on your house? No. Right? But you guys have to, again, in exams coming, you got better be more compelling and more quick on that. Kyle? Well, then it's an investment property. You've transformed it from a personal use property to an investment property, right? And we'll talk about that. But for now, it's a personal house, and if you have a loss, it's going to be disallowed. Right? Now, someone gives you a gift, a property, that they bought for $10, it's now worth $100. Andy, what's your basis in that property? 10. What's your authority?
The authority is 10.
What's his? 1015A, right? What? If I bought it for $10,000, what's my basis, David? If I bought it for $10,000, what's my basis? What's your authority? 1012, right? And now I put some improvements on it, Ben. What's my basis? I put $2,000 worth of improvements. Ben? What's my basis? Ben? 1016. It's adjusted upward, right? To 12. If I start taking depreciation deductions, Caitlin, any adjustment to my basis?
Wait, sorry, I'm not following what's going on. You just said...
If I make $2,000 worth of improvements, my basis goes up by $2,000, right? Authority 1016, and if I start depreciating the property link, what's the basis you have in the property? Anything happen, Topeka? Do you agree with that, Sierra? Ying? So if you take depreciation deductions, Eric, no adjustment in basis? Eric, any adjustment in basis if you take depreciation deductions?
No.
Why would you not adjust basis? If I buy property for $12,000 and start taking depreciation deductions, wouldn't you expect there would be a basis adjustment downward, Code Section 1016? Agreed? Upward and downward are basis adjustments. Now, when I give a gift, as Annie said, she cited Code Section 1015, where there's carryover basis. Martina, is that always the basis, carryover? If I bought something for $2,000, it's now worth $10. I gift it to you. Is your basis always $2,000? Any scenarios you could come up with where your basis might not be $2,000? It's always $2,000. If I bought it for $2,000, I gift it to you when it's worth $10. What's your basis? Is that property always, the basis of that property always $2,000?
Yes.
Doug?
1015B6, anything after 12/31/1976.
What happens if there was any gift tax, Martina, if I paid? Would there be a basis adjustment, guys? If I made a gift, MJ, to you, and there was gift tax paid, there is not equal to the gift tax, right? That's under 1015D1, which is old law. But 1015D6, a proportionate amount, basis goes up. MJ, you had your hand up. It's not increased by the gift tax amount. That's old law, right? 1015D1 has been usurped by 1015D6, right? Everyone agree? Again, these make for a very good exam questions, so be forewarned. You guys should be able to nail this. And if I buy property for $2,000 and it's now worth $500, okay, everyone have it? I bought property for $2,000, it's now worth $500. And I give it to you, Kevin. What's your basis in that property? Carol? Always? Stefan, what's the basis? If I bought property for $2,000, it's now worth $500. I gift it to you. What's your basis? What's your authority? 1015 what? 1015D deals with gift tax. There's no gift tax. Let me just, David? Come on, guys. I bought it for $2,000. It's now worth $500. So in your notes, just jot down two numbers. I give it to you, David. What's your basis in that property and why? And what's your authority? I mean, this exam is going to kill you guys. And let me just, and I don't mean to. I want you to succeed. But if you got to know this stuff, and there's not that much to know yet. Go ahead.
How much you sell it for?
It will depend on how much I sell it. Suppose they sell it for $450. Any gain or loss? And if so, how much? They sell it for $450. How much is my loss? 50, right? Because 1015A says use the lesser or fair market value or adjusted basis. If I sell the property for $2,020, everyone have that? I sell it for $2,020. Okay? Any gain or loss on that one? NECA, any gain? How much? $2,020. 2020. $20? Do you agree, Howard? Who's right, Hamira? NECA's right. In that case, you do take a carryover basis, right? Right? These are all spelled out, not because I told you so. This is what the code says, guys. It's what the code says. Yes, Joe.
What was the answer to the $2,500 where you gifted the $500, but it was worth $500 and you gifted it?
I'm missing you. Okay. I bought it for $2,000, worth $500 now. What's the fact pattern?
And then you gifted it.
I gifted it. It depends on what it subsequently sold for. Will determine the basis up front. It depends. And if I sell it for $750, Patty, gain or loss? I sell it for $750. MJ? I bought it, guys, for $2,000. I gifted it to you when it's worth $500, and now it's sold for $750. You sell it for $750. What do you report in your tax return? Jing Jing. You're killing me, guys. Really. Go ahead, Larry.
No gain or loss.
No gain or loss. We went over this. Was I here last week? Were you guys here? No gain or loss under Regulation 1015-1, right? We went through that example, right? Right, MJ? You're here? You saw that? You remember that? All right? Jing Jing, you were here? I know you were here. You got that? Hey, guys, are you know, beyond being physically present, mentally you got to make the effort here, else, again, if you try to put all the effort to just studying, but you're not going to be here mentally, following along or after class, writing this, rewriting it, this is all new language for many of you, right? This is not, you know, stuff that you're used to doing. And don't put the burden on yourself and waiting until the end to try to put it all together. If you don't do this after each class, try to put it together and during that week, and then when you're really studying, just mastering it, that's, you know, don't try to master it all at the end. All right? Review your notes. Because this concept of basis, if you don't know a property's basis, you're going to be at a loss. Okay? You can't perform tax unless you know a property's basis. All right? So we have different code sections. For example, Mike, I bought the property for $500. It's now worth $2,000. Mike, I bequeath it to you. What's your basis in the property and why? Mike? It's Mike, right? Yeah. Mike? It's you, right? Is there someone else? All right. If I bought it for $500, it's worth $2,000. I die and bequeath it to you. First of all, Mike, do you have income when I bequeath it to you? No. What's your authority? 102A. I'm not your employer. Okay? Now, Mike, what's your basis in that property? Okay, what's your authority? 1014A, right? Now, is basis choice always fair market value? On what?
Whether it's gain or loss.
Shengnan? Is that true? And you are, I'm sorry, I don't, and I'm missing yours too. Your placard. So, Zan, I'll give you another one, but you got to have your placard. Zan, gain or loss? What is the basis always $2,000 is my question. Zan. Always. Always. Amanda? Well, give me the fact pattern. Given Mike, I died, I bequeathed it to Mike. When would Mike not have a 2,000?
He gave it to you within a year of your death.
If Mike gave it to me within 1 year of my death, what basis would Mike have in that property? Say again, Amanda?
The cost basis, whatever cost basis there.
The initial cost basis that I have, so it would be $500, okay? If he gifted it to me and then I bequeathed it back to him, the basis would not equal fair market value. Authority 1014E, right? So you guys should have this in your notes, meaning you should have the general rules, you should have the exceptions. And now we're about to move on to amount realized, unless you guys have any questions. Any questions? Doug?
So it's within a year, it's 1042.
I'm sorry?
You say within the 1 year period?
Yeah, if Mike looked at me and said, hey, Solid, here's some property, hopefully this will make you feel better, but Mike really knew I was going to write a will that bequeathed it back to him. Okay, so he gifted it to me when his basis was $500 and it was worth $2,000, so I have a $500 basis in the property, 1015A. I now die and bequeath it back to him. He does not get a basis equal to $2,000, right? Taxpayers didn't, the Congress did not want taxpayers to wash property through people who didn't look too healthy. All right? Amount realized. Now in theory, this would seem really easy, right? Because remember what Code Section 1001 says, that it's amount realized less adjusted basis equals gain or loss, right? And the authors in the first part of the chapter discuss what is your adjusted basis. Everyone agree? They move on now to talk about what is your amount realized. And it seems straightforward enough that it's going to include any cash you receive in the fair market value of any property you receive, right? Cash or fair market value of any property you receive. Okay? So that seems easy enough to follow. And on page 139, the authors give us this International Freighting Corporation case, which is not one of the most important cases around, but this case a company used appreciated stock to satisfy a debt. And what I mean by that, appreciated property to satisfy a debt, is suppose you owe, wait, Jin, you owe, say, $100,000 to me, okay? So Wei Jin owes $100,000 to me. He owns Apple stock that he bought many years ago for $10,000 that is now worth $100,000. Everyone get the visual? Wei Jin owes me money, $100,000 to be exact, and he bought Apple stock when it was worth $10,000. It's now worth $100,000. And he's going to pay me. He's going to satisfy his debt with the Apple stock. Is that considered a realization event, where you use appreciated property to satisfy a debt? Is that considered a realization event? And the answer is, Wei Jin, what do you think? Yes? No? If you use that $100,000? Not sure? Zhao?
He should use the cost of property as a basis.
Well, if he pays me with his Apple stock, does he have any income as a result? Do you depreciate stock? Apple stock, do you depreciate? No. You know the answer to that. Okay, so the question is, when he uses his Apple stock to satisfy his debt to me, does he have any income? Yes? No? Shangnan, do you agree? Yes, you agree? Do you have authority for that? Larry?
I'd say yes, 90,000. And it's this case.
Yeah, guys, I'm not going to be a very good poker player. I mean, it's right here, spelled out in this case. International Freighting Corporation says if you use appreciated property to satisfy a debt, it's the equivalent as if, Wei Jin, you sold the Apple stock for $100,000 and paid me cash. Okay, that's the equivalent, right? Couldn't he have sold his Apple stock? And if he had, wouldn't he have a $90 recognition event or $90,000 recognition event? And that's what the code, or this case, says. That's the equivalent, right? That is the equivalent. So if you look on the top of page 141, but is the delivery of the shares here constituted disposition for valid consideration? It resulted in a closed transaction with a consequent realized gain. And towards the very bottom of the page, the last long paragraph, towards the very bottom, it says, essentially, treat this as if it were sold. Okay, so the authors give us this case. It's one of those cases you can't use, in my opinion, at the cocktail party. No one's going to know it. But the Crane case, by way of contrast, people will know. All right, when I say people will know, those people who you truly want to hang out with will know, because this is one of those important cases that anyone who practices in tax should know the Crane decision. It's one of those 10 cases, top 10 cases, at least in the federal income tax area, that people know. Add this to your repertoire of cocktail conversation that you should have down. It's a very well-known case. All right? And I did, in an earlier email, send you a one-page overview of the case that hopefully you guys have and you copied out. Caitlin? No. Using appreciated property to satisfy the debt is the equivalent of selling that property, taking the proceeds, and satisfying the debt. That's the takeaway, Caitlin, for your notes. Okay? If you don't understand my takeaways, raise your hand so your notes are clear now. Weeks from now, it doesn't make sense for you to go back and then ask me the question. Now is the time to make sure you understand what these cases stand for, their proposition. Crane, much more important case. What is going on in the Crane decision? Who wants to take a stab at it?
Okay,
All right, Sierra.
so there was a
Okay, but let's slow down a bit because let's personalize these cases. Because if you just read it for plain vanilla facts, now you lose the human side of it, right? So you got to see beyond. You got to get dimensional here. I think it's up to you because I think tax in these cases, if you just read them for the plain vanilla, you miss it. So what happens here? First, husband dies, okay? So your heart has to go out to Mrs. Crane, but at the same time your heart's going out, what else are you thinking about? Because from now on I've cursed you with respect to every death. What are you going to think with respect to every funeral from now on that you go to? You're going to be thinking Code Section 1014, right? I'm sorry. You are cursed forevermore because you will go to that funeral thinking Code Section 1014, at least as long as it's operative, Code Section 10. By the way, Code Section 1014, when Mitt Romney talks about, I saw excerpts of the 60-minute interview yesterday. Actually, I didn't see I actually saw a part of after the football game for those who watched. I couldn't resist hearing Romney talk about his tax plan, and he said he's going to cut marginal tax rates by 20% across the board, but he said he recognized that we had to keep it revenue neutral, so we have to get rid of all these deductions and loopholes. And theoretically, what code section would go by the wayside if Mitt Romney were elected president? What big one? Hint, hint, we're looking at it right now. 1014, right? Because isn't that a tremendous leakage to the system, 1014? Doesn't the government lose billions of dollars vis-a-vis Code Section 1014? That when people like Bill Gates die, who has, I'm making up a number, let's say $100,000 tax basis in his enterprise, and it's worth $30 billion. $30 billion of taxable gain disappears vis-a-vis Code Section 1014. Everyone agree? 1014 is tremendous leakage to the system, right? So I don't want to say anytime for here on in, when you go to a funeral, you'll be thinking about Code Section 1014. In other countries like Canada, they don't have a Code Section 1014. What happens in Canada, on your final tax return, any appreciated property gains or losses get picked up on your final tax return. So death is considered a recognition event in Canada. So that if you own IBM stock that you bought for $10, now worth $100, you pick up on your final income tax return in Canada $90 worth of gain. So when you hear the Wall Street Journal say, well, look at Canada, they have no estate tax return. They have no estate tax. Well, they have something in lieu of an estate tax, a deemed realization rule. But for the time being, we have this Code Section 1014. So when you read this case, Sierra, you see, unfortunately, Mr. Crane died. Mrs. Crane, a widow, right, inherits this property. And that's important. You might say, well, who cares? I mean, who cares? But it's important because of our basis determination here, right? That's critical. So that determines her basis in this property, right, Sierra?
Well, there's some confusion on how to determine the basis of the property as well as amount realized.
Don't be so confused because one thing for sure, we know 1014A applies here, and her basis is equal to fair market value. Okay? Her basis in this property, and if you have the one page that I gave you, her basis in the property is coincidentally equal to the amount of debt on the property, which is $262,000. Okay? So her basis in this property is equal. There's an outstanding debt on this property of $262,000, and she determines that to be the fair market value. So picture, if you will, if you own property with a $500,000 debt and your spouse dies, it was determined that your basis, the fair market value of that property, was worth $500,000. Here, the number is $262. So, and we have a value put on the land and the building, two different values, one on the land, one on the building. The value of the land, $55,000. The value of the building, $207. Okay. She continues to own the property, right, Sierra? Does she make principal payments? Is she able to pay down her debt here? What? No, no, no. Oh, forget about the memory. Let's take the facts. Nothing happened yet. Don't fast forward. During the term that she owns subsequent to her husband's death, she does not pay any of the debt, and it continues to accrue. Okay? So the debt rises. Okay? The amount of the outstanding liability rises to $270,000 approximately. Does Mrs. Crane depreciate this property, Sierra, during the years that she owns the property? Forget about what the court said. Did she depreciate the property? Yes? Yes. She depreciated it, right? As well as she could. And Shangnan, this is a good time to depreciate. When you use property in a trade or business, you can depreciate it, right? You guys know that from your general principles of accounting, right? You use property in business, you can depreciate it, right? Can you depreciate land? No, it has no useful life, but the building does, right? And for your edification, if you were to check out, you don't need to now, we'll learn it later, Code Section 168, the buildings now are depreciated over how many years for tax purposes? You don't know this yet, but generally 40 years, okay? 40 years. All right. So she's depreciating this property, and she subsequently sells the property, right, Sierra? She sells the property. How much cash does she get? Everyone heard $3,000. How much in the way of expenses does she have? $500. So what's in Mrs. Crane's pocketbook when all the dust settles? How much? $2,500, right? And Pretty, how much does she actually take into income as a result? $1,250, because under the then capital gains rules, you don't have to worry about it because this was considered a capital gain. She was able to reduce the amount of income she had to take into account. But that's yesteryear's rules. That wouldn't happen. That's not an issue in that's not what Crane is all about. We don't care about what those rules were back then. What we care about is, was she right in her posturing, meaning should she have included as her gain here? She said $3,000 less expenses, meaning her amount realized was really $2,500, that she claimed she had a zero basis in, and that her gain here was $2,500. That's really the issue. All right? That's her position. What does the IRS say here? Does the IRS say sign off on this, Sierra? Why not? I mean, she really only has $2,500 cash, right? So what's wrong with her position from the IRS perspective? Does the IRS have a problem with her basis or amount realized or both? The amount realized, the IRS is troubled by, right? What does the IRS say should be includable in the amount realized? The liability. That the liability should be considered part of the amount realized. What was the amount of the liability here? The liability here, the principal amount was $255,000. Okay? So the IRS is saying, for computational purposes, $255,000 should be considered part of the amount realized, plus the $2,500, that the real amount realized was $257,500. Why? Because this liability. Go ahead. It's already deductible, the interest, so it didn't need to be taken into account. It was already deductible under the then Code Section 163, so it's ignored for our purposes because it's deductible. All right? And because her adjusted basis in the property, in the building and the land, was $233,000 after depreciation, that she had to take $23,502.60 into income. Okay? Again, you guys should all have my little overview here that helps follow, but you got to read the case. If you try to shortcut this, you're doing yourself a disservice. You're not going to get this stuff down. All right, so there are the facts here, right? Those are the facts. And now the U.S. Supreme Court is called on to analyze this set of facts. And how is the court going to approach this? How is the court going to approach this, Sierra? What's step one and what's step two? How is this decision set forth?
First, they try to define the equity and differentiate that value of the
Well,
jumping.
well, you're not jumping ahead, but you're not thinking the frame. What is the framework of the opinion, Larry? What does it look at first?
Basis.
It looks at basis first. Now, you're right, Sierra. They'll look at the word equity, absolutely. But it looks at adjusted basis first, and then the second step is to look at amount realized. In other words, the key question before the court is obviously what was the taxpayer's amount realized, but the court feels that it can only answer this question by looking at the taxpayer's adjusted basis. So a predicate to answering what is the amount realized is that we look at adjusted basis first, right? And what does the court decide here, Sierra? What is it going to, when it looks at basis, what is it going to look at first?
The original debt,
But what is it going to say includes the word basis, MJ? You had your hand up.
The original basis includes the inherited mortgage that she needs to use.
Doesn't include, well, let's see what her argument is spelled out on page 144. She says that the then code, remember the code sections here, right, are numerically different from our code, right, because this case predates the 1954 code, right? And the pre-54 code talks similarly about property, right? Everyone agree? It talks about this word property and what your basis should be in property. And Mrs. Crane says when the then Internal Revenue Code refers to the word property, it refers to what? What is the thrust of her argument, MJ? It refers to what? It refers to equity, right? She said when you think about the word property as used in the Internal Revenue Code, its real use meaning is equity. Does the court agree with that? Does the court agree with that? No. Right? The court does not agree with that, right? Because what does it do to convince us, the reader, that the word equity, or excuse me, the word property is not synonymous with equity? What does it do? What does it do to achieve that goal? How does the court convince us that the word property and equity are not synonymous? Goes to the dictionary, right? Just like Panera Bread, and they pull out Webster's, they look at the word equity, they look up the word property, and guess what's not there? The word equity. That the word property and equity cannot be used interchangeably. And that the word property means the actual underlying property and not the equity that someone has in property. So when someone dies and you say they take a basis equal to fair market value in the property, it doesn't say you take a basis equal to the amount of equity, right? Because if that were true, what would Mrs. Crane's basis have been in this property when her husband died? Would have been zero, right? The husband, when he died, had no equity in this property. Everyone agree? Now, obviously her position is inconsistent, right? Because What did she do for 6 or 7 years? Did she treat this property as if it had a zero basis? No, she took depreciation deductions. So now she's switching it around to say, oh, I blew it. But the court is not going to be so receptive to that. And says, when it starts looking at, first of all, the dictionary definition, it says that the word property does not mean equity. Secondly, it says the IRS has consistently said you use property as that term is used in the dictionary. So when someone dies, taking a fair market value in the underlying property itself, ignoring the debt. You don't consider how much debt the property has. And then consider this. If you start depreciating property, most of you are familiar with the concept of depreciation, right? Picture two scenarios. One, you buy property, a piece of machinery for $100,000 and you start depreciating it. And just to keep the numbers real simple here, over 10 years, okay? How much depreciation are you going to have? And I'm very much oversimplifying that. If you have 10 years and the machinery costs $100,000, $10,000 per year. Everyone agree? Not too hard to follow, right? But let's change the facts a little bit. Let's suppose you borrow $40,000 and you put $60,000 down and you start depreciating it. And under Mrs. Crane's methodology, what would be your basis upon which to depreciate? It would be the amount of equity you had in the property, or $60,000, right? And every year you made a principal payment, you would have to readjust what would be your depreciation measuring rod, right? It would be an administrative nightmare, right? If you try to depreciate property based on the amount of equity you had in that property, we talked about administrability, our first class. Is that a recipe for disaster if you use equity, as the basis of depreciation? It would be a nightmare. And the court, look, at the end of the day, who are the members of the Supreme Court? You know, they're taxpayers, they get the tax system, and they know that if they write the recipe for disaster, they're not going to be well received. So they do take into administrative concerns, and they say this wouldn't fly. All right? So they decide that the basis of this property, okay, is going to be fair market value on the date of death, and whatever the liability is, it doesn't matter, okay? And then beginning on page 148, Sierra, the author, in terms of framework, the authors will now, the second part of their analysis will now cover the amount realized, okay? So the second part of their analysis deals with the issue of amount realized. And what determination do they reach about amount realized? Right. I mean, they're going to say whatever they did with basis, they have to be consistent. At the end of the first paragraph on page 148, it says if the quote-unquote property is to be valued on the date of acquisition as the property free of liens, the property to be priced on subsequent sale must be the same thing. So when property is subsequently sold, the amount realized is the actual sales price, even though the amount of cash the person receives, in this case Mrs. Crane, may be less. That's immaterial, because part of the sales consideration is the assumption of the liability. Right, so this has now been memorialized in regulation. So the authors asked you to, I hope you did, look at Regulation 1001, okay? Look at Regulation 1001-2. 1001-2A. It says, except as otherwise provided in paragraph A2 and 3 of this section, the amount realized from the sale or other disposition of property includes the amount of liabilities from which the transferor is discharged as a result of the sale or disposition. I'll repeat. Notice, the amount realized from a sale or other disposition of property includes the amount of liabilities from which the transferor is discharged as a result of the sale or disposition. Everyone see that? That's A. That's 1001-2A. If you look at 1001-2B, entitled Affect the Fair Market Value of Security, it says the fair market value of security at the time of the sale or disposition is not relevant for purposes of determining paragraph A of the section, the amount of liabilities from which the taxpayer is discharged or treated as discharged. Thus, the fact that the fair market value of property is less than the amount of the liabilities does not prevent the full amount of these liabilities from being treated as money received from the sale or other disposition of property. I have that highlighted in my own regs as in red, that line, thus the fact. How does that play into our Tufts decision? Anyone want to take a crack at Tufts and how that one sentence plays into it? Sierra, you're on a roll, all right?
Well, that it doesn't matter if the amount of, whether it's positive or negative, the shares of losses still computed as part of the amount of the other.
All right, so let's go through it slowly. I don't know if I like your reference to a loss. So what happens in this case? Doug has his hand up. A partnership buys an apartment complex. Do they put much money down? Doug? Do they put much money down? All right, so they do a lot of financing here. They're not putting a lot of their own money up here, right? Everyone agree? They're putting very little money down, and they're getting the rest from the bank. And whose neck is on the line here? Whose neck is on the line here? The taxpayers or the bank? The bank. Why? It's not recourse, right? And the bank does not have a lot of cushion here, if you notice, right? The taxpayers put up a little money. The bank lends a whole lot of money. To be exact, how much does the bank loan? The bank lends $1,851,500, right? And the taxpayers buy this property, and what is their adjusted basis at the time of disposition? They start depreciating the property, they buy the property, and just they take depreciation deductions on the full fair market value of the property, right? What's their adjusted basis in the property? How much? Not four. Yeah, 1,455,740. Okay, is their adjusted basis? Okay, and at the time the property is sold, what is the fair market value of the property? Say again, Amanda? 1.4 million, right? This is the fair market value. Okay, everyone have this? Okay, Amanda. From the taxpayer's perspective, they have a gain or loss here. From the taxpayers, not the IRS's perspective, from the taxpayers. How much? Yeah, I mean, whether or not they've been to our class, guys, they know how to apply Code Section 1001, right? So they say, amount realized, 1.4, adjusted basis, 1,455,000 loss, right? Did they report this loss on their tax return, Amanda?
Yes.
Do they? I know you usually skip over footnotes, but look at footnote 1. What does it say? So Amanda, did they report this loss? No. Now, what might that signify to you in the classroom if your clients don't report the loss? They're trying to stay under the radar screen here, right? Because most taxpayers, when they have losses, they're going to report them, right? Everyone agree? So the fact that these taxpayers didn't report the loss is suspicious. Everyone agree? We don't know yet, but it doesn't look good. Now, what is the IRS's position here? Doug?
That it should be a gain of 300,000 include full amount of
All right, so the IRS takes the position, what is the amount realized here?
300.
What's the amount realized? That's what they say is recognized. What's the amount realized? Ah, the IRS is saying this is the amount realized. Everyone agree? Under the Crane Doctrine, the amount realized is the amount of the liability plus any cash, and now we have a regulation that affirms that as well. Less the adjusted basis creates a gain of approximately 400,000, something like that. Who wins? Doug? MJ?
Trial court rules the IRS, and appellate court reverse state, Supreme Court rules the IRS.
The Supreme Court rules for the IRS. U.S. Supreme Court says that this is what Crane instructs, and now we have a regulation directly on point that would constitute the amount realized, giving rise to the gain as the IRS suggests, right? So that's the outcome. Justice O'Connor, who recently retired from the Supreme Court, has a slightly different variation, but would come to the same result in her concurring opinion. Anyone not following this case? Again, I encourage you to read the cases before you come to class, because it helps follow what's going on, and circle some of the numbers and the relevant facts, write them down, jot them down, and then after class review them consistent with what we say, because you'll pick up a lot from these cases and how they're written. They are not impenetrable. In theory, the people on the Supreme Court are supposedly some of the best prose writers in our country, right? So it's never a bad thing to read good prose, right? Hopefully helps you with your own. Ready to look at the problems on page 158? Mortgagor purchases a parcel of land for seller for $100,000. Mortgagor borrows $80,000 from the bank and pays that amount and an additional $20,000 of cash to seller, giving bank a non-recourse mortgage on the land. The land is the security for the mortgage, which bears an adequate rate of interest. Okay, everyone get the visual? Someone's putting up $20,000, borrowing $80,000, purchasing property for $100,000. All right, what is mortgagor's cost basis in the land? So let me just ask Hal, Shuyu, what do you guys say? What's the basis in the land? Do you agree? How? And would that be right, Patty? And if so, what would you cite for authority? Rand, what would you cite for authority? 1012, right? The answer's right. It's 100,000. Just wanted authority for the proposition. Cost basis, right? Isn't that kind of neat? You only put out 20,000, but you're still getting a basis for 100,000, right? Why? Because if we just looked at equity, if this was a depreciable building, it would be a real problem, right? If we had to make depreciation deductions based on equity. Everyone agree? Two years later, when the land is appreciated at $300,000, a mortgagor has paid only interest on the $80,000 mortgage. Mortgagor takes out a second non-recourse loan or mortgage for $100,000 with adequate rates of interest in the bank, again using the land as security. Does mortgagor have any income when she borrows 100. So if you get the visual picture, if you will, you buy this land for 100,000, it appreciates up to 300,000, and a lot of people try to take money out. The question is, are they subject to tax when the money is taken out? Joe? Taxable or not? So it's taxable? And if so, what code section? Pretty? Would you say she's right? David? David? Jenna? Taxable or not? Joyce?
I'm not sure of the code, but it's not taxable because it's considered a debt and you still have to repay it.
Joyce, do you feel any richer when you take out the mortgage liability? In other words, when you get this extra $100,000, do you feel richer? Yes or no? That's a yes or no question.
Sure. Yes.
You do? You sound like the advertisement. You know how they say, borrow against the equity, you deserve it, redo your kitchen, redo this, and do you feel, should the person who gets that money feel any richer? You shouldn't feel a dime richer. Now, the advertisements say you deserve it and you should feel richer, but the reality is you shouldn't feel a nickel richer. Everyone agree? Should you have taxable income? Do you feel like you have an accretion to wealth? Again, you shouldn't. I mean, that hasn't stopped taxpayers. That's why we got into the housing crisis. But the reality is you shouldn't feel richer, and you're not going to find a code section. All right? And you might say, well, that's sacrilegious. No code sections, no answer, right? But the answer is found in the court case, right? The authors of our, if you guys had your computers open, it's cite to, you could Google Woodsum, right? The case mentioned, and it stands for the proposition that borrowing does not give rise to taxable income, all right? Not found in the code, but that's okay. There's judicial authority, right, guys? What is mortgager's basis in the land if the $100,000 of mortgage proceeds are used to improve the land? Okay, everyone have that? What is mortgager's basis in the land, Ling, if Raquel, did you hear what she said? You're not being fair, Ling. Say it louder. That's your loudest voice? Ling, say it loudly, please.
I think they all have to.
Why? Matt, would you agree? Let me hear from Ron. I haven't heard from him. Think it goes up? Okay. What's your authority? Perfect. Right? The buck stops with Ron, right? Right? Goes up, right? If you make an improvement on property, your basis goes up by 100,000. What's our authority? Code section 1016, right? Does that make sense? Ling, you agree? You're whispering yes. Come on, I'm telling you, if you're going to talk to your clients, Ling, seriously, I mean, you think I'm joking, but if you're going to talk to your clients, you got to project your voice. If you don't, you're going to come across as meek, and you're not going to get the client base. And let me just tell you guys, when you're working in your offices, and you can approach your work in one of two ways, in my opinion. Like, there's, to me, two fundamental kinds of people in an office. Those who are known as the workers, who all they do is try to service other partners at a firm, Ling. That's all they do. And if things get, and then let's talk about the other kind of personality who goes out there and tries to develop a client base, okay? So we have two different kind of people in every office. And again, I'm pigeonholing offices in this bifurcated fashion, and sometimes there's people in between, but generally there's one of two. If things get tough, who's the person who's let go, Ling? Person A or person B? The person who's the real hard worker or the person who brings in business and also spends time on the golf course? Who gets let go first? The hard worker gets let go first, guys. All right? Okay? Because the person who brings in business can support him or herself, right? So just be forewarning that you really have to do it. You know, I don't care what it takes, but, and I don't mean to give you a hard time, but I'd rather give it to you than someone else, is that you got to really project yourself and have it, you know, because even if you're quiet, that's projected. The notion is weakness, you're unsure. So even if you're sure of yourself, if you do it in a soft, I'm not saying to have a rough demeanor, you know, being out of control, but you got to, you know, command a conversation, or else you're not going to be that person B. And if you're person A, again, as things change in a firm, your job's on the line. My message to you also is every single person here really should go out and develop a client base. That is your only security in this world. There is no other security, all right? Even if you're great at what you do, if you have to rely on others to feed you work, you're at risk, all right? So be forewarned. I learned that early on when I used to do adult education schools, trying to develop a client base, is that you're at risk. I saw it at firms left and right. The people, whenever things got a little tight, the first people to go are very good people, but they go when things get a little tight. Okay. Question D. Go ahead.
What was, so the basis in that, the amount, is that then 200,000?
Yes. Question C, $200,000. And see what Caitlin's doing. She wants to make sure her notes are perfect. Perfect. And I applaud her for that, for when she's studying. So now's the time to dismiss, you know, ambiguity in your notes. 200,000 is the answer. Code section 1016, it's an adjusted basis if you check. Code section 1011 talks about an adjusted basis. Code section 1012 is your cost basis. Question D, what is mortgager's basis in the if the $100,000 of proceeds are used to purchase stocks and bonds worth $100,000? Larry? Would that be correct, Ben? 1012? Now, while you're studying Woodsum, admittedly, this person does not have income for taking out the loan. Everyone agree? The second mortgage does not give rise to income. But this is more a question of basis, right? Not a question of income, right? Everyone agree? This question pertains to the issue of tax basis. You're Larry, addressing a different, you're citing to a case for a different proposition. The question here pertains to the tax basis, and the answer here is if you borrow against property and you use that $100,000 to purchase Apple stock, you will have an additional $100,000 in the Apple stock, Code Section 1012, but Code Section 1016, right, Larry, does not permit a basis adjustment to the underlying land because you haven't used that to improve the underlying land, right? So if you cite it to Woodsum, I'd have no choice but to mark it wrong because that's not the question.
It also said that subsequent borrowing is not included in the basis.
Who said that?
I read this.
Okay, you read the case and it said it's not included. I haven't read it in a while, and you may be right. So Larry, I'll stand corrected. Right? If the case adds that point, so be it. So the answer here is the basis stays at 100,000. 1012, and the fact that Code Section 1016 does not permit a basis adjustment here. On an exam, it would be a better answer to state both. What results in the facts of D above if when the principal amount of the two mortgages is still 180? Everyone see why it's 180? We first borrowed $80,000 to acquire the land, and then we subsequently borrowed $100,000. Okay, everyone agree? So that's where they come up with 180, and the land is worth $300,000. Mortgager sells the property subject to both mortgages to purchaser for $120,000 of cash. So there's only $120,000 of cash exchanging hands, right? any gain or loss, and then the second question is what is purchaser's basis in the land. So any gain or loss here to the seller here. So Stefan, Carol, any gain or loss? And if so, how much? And Arish, see if you agree with your neighbors. Stefan? There's a gain. If so, how much? How much? 200, I hear. Carol, agree, disagree? You agree? Arish?
I agree as well.
You don't have your placard up. Oh, it's hanging there. I can't see. I'm sorry. Doyle, that's right. Okay, Doyle, if you agree, prove it. What's the amount realized? What's the basis here? All right, let's go slowly for everyone, okay? Because, Doyle, where did you get the amount realized being 300? Okay, but can you prove it to everyone? Stefan has his hand up. Okay, so the amount realized here includes what? The cash received, everyone agree? No doubt, 120. Everyone agree? Plus the liability of 180. So our amount realized here is 300,000. Agreed? What's our basis here, Kevin? You're going to lose this client, though. Martina? How much?
100.
What's your authority?
10, 12.
Okay, Igor, would you agree?
I would say 100,000 would go to 1016.
John, would that be right?
1012 at 10.
Would you cite to code section 1016 here? There's no adjustment here, right? It's 100,000 from problem D, right, Martina? Just state at code section 1012, there's no need to cite to code section 1016. Everyone agree? So the gain here is 200,000. 300 less 100 gives rise to 200 under code section 1001C. Is that gain recognized? Is that gain recognized? Yes, code section 1001C says, except as otherwise provided in the subtitle, that gain shall be recognized. Doyle and then Jared.
You said for part D, basis is 100,000 because of 1016. Is that purposes you want us to?
Well, here there is no adjustment under 1016 to my knowledge. There is no improvements made, no depreciation.
Were there any adjustments in part D? They were purchasing stocks.
Yeah, but I said that there is no adjustments under 1016.
No, I don't. For the exam, I'm just wondering for the exam, do you want us to answer no under 1012 and 1016, or just no under 1012? Because I thought in part D we said no under 1012 and 1016.
In question D, all I said was 1016 didn't apply. So for your notes, that's all I would. And it can't hurt to, if you want to add that, 1016 doesn't apply. That's fine. All right? Now, purchasers, oh, Jarrett.
Maybe I'll read the statement wrong. Or there's still a property subject to both parties that the buyer is assuming both.
Right.
Okay.
The buyer is assuming both. That makes economic sense. You wouldn't sell it otherwise, right? Now, what is the purchaser's basis? Al, way up there. What is the purchaser's basis in the property? Al? What's the purchaser's basis? David, see if you agree. You don't know? David? Bill, would you agree? Gary, agree? Bill? Is there any gift here, Bill? You read anything in the fact pattern denoting a gift?
No gift.
Do you want to cite to 1015? I don't think so. Gary, what code section? 1012, right? Cost basis here. And akin to crane, do you take into account the liability? Yeah, the fact that there's an embedded liability and the fact that the person only had a cash outlay of 120, immaterial, right? So the basis here is the value of the property, 300,000. Code section 1012. Everyone agree? 300. Caitlin, you got your notes down? $200,000 gain, $300,000 basis, right? Question F, what resulted in the facts of D above if instead mortgager gives the land subject to the mortgages still worth $300,000 to her son? Aw, wasn't that nice? Mom gave son a gift, right? What is son's basis in the land, okay? Now, pause for a moment, picture the visual. Tax is about, anyone who likes acting should really appreciate that, but even if you're not into acting, suck it up. Role playing. So picture if your mom giving this property to her son, right? And tell us the tax consequences associated with that, okay? Now, MJ, we'll make you, since you have your hand up just for a moment, Mom, and we'll make Chris your son. Mom, you're giving this property to your son. And first of all, Chris, do you have any taxable income upon the receipt of this gift? And what's your authority, Chris? 102 what? 102 says a lot. 102A, right? Again, just like Ling, you got to say it more convincingly than that because otherwise you're not going to get that client. 102A. I meant Ling. All right, so you have no income. MJ, when you give this to your son, do you have any income? And then let me ask he and John if you agree. And Joyce, I'll ask the three of you. MJ, any income when you give this nice piece of land to your son? All right, let's just give me an answer, then we'll see if your neighbors agree, and then you can explain how you got there. Any income to you? No one can agree or disagree if you don't say yes or no. No income, you said. Okay? E, John, Joyce, any income? No? No. Anyone say income or we say no income? Chris? You're going to be a contrarian here? And what do you say?
I think it's similar to we're 180.
So what's the gain or loss? To mom. Your mom. Your mom just gave this property. Does she have any gain or loss to you? Be strong here. Be strong, Chris. Because you're on the right path. Let me help you. Be strong. Think.
She has 180,000 income because of.
Use your vocabulary. What's the right word? 180 of what? Use your framework. Don't say basis. Amount realized. MJ just gave you property subject to liability. Does she have an amount realized here, guys? Because Chris just took over that property. He assumed $180,000 worth of liability, right, Chris? That's an amount realized. MJ, you just relieved yourself of $180,000 because your son took over that property, right? Now, don't stop there. What's MJ's basis in the property? Does she have any gain or loss?
She has a gain of
Right on. Right? What's her basis in the property? 100, right? Sierra, she has a basis of 100,000, right? Pretty tricky, right? Now, it's not that tricky, though, because if you guys had done today's reading, look at 1001-1, right? That was part of the assignment, 1001-1E. Open it up. 1001-1E. Entitled what? MJ, since you're mom here. Regulation 1001-1E.
Transfer
1001-1E.
to
Hold on, guys. Does this seem a ring with familiarity? Is this a transfer part sale, part gift? I mean, MJ's being generous, right? She's giving a gift here. Chris has got a smile left to right. But it's also a sale, right? Because Chris is agreeing to take the property subject to a liability. Everyone agree? And what does 1001-1E say about computing gains and losses? When a transfer of property is in part sale, part gift, the transferee, in this case, that's MJ, has a gain to the extent the amount realized by her, not him, her, exceeds her adjusted basis in the property. What's the amount realized here? No, the amount realized is how much? Don't you just, Chris took the property subject to liability. The amount realized here is 180, right? You didn't get a dime of cash here, right? The amount realized here is the amount of liability, 180, right? What's the basis here? 100. Last I checked, I know it's complicated math, 180 less 100 is 80, right? Pretty tricky. Mara, you got that puzzled look.
It's not puzzle.
It's not? You can nail this on an exam?
Yeah, I got it.
All right, that's what I want to hear. Now, that doesn't answer all the questions. Now we got to know Chris's basis in this property. Chris's basis in the property. Okay? Larry?
Said 180,000.
And what's your authority for that?
1.1015-4.
1015-4. You want to open it up, everyone? 1015-4. Entitled, right, MJ? It's entitled, once again, transfers in part a gift and in part a sale. Notice, you might say, you know what? This Internal Revenue Code could be a lot shorter. There's a lot more, there's so much repetition. Why does it say it twice? Why? Well, the first one were the regulations under 1001 that describe gains and losses. What do the regulations under 1015 describe? They describe basis, which we all know is an entirely different issue. Everyone agree? An entirely different issue. And it says, general rule, when the transfer of property is in part sale, part gift, the unadjusted basis of property in the hands of the transferee, that's in Chris's hands, he's the transferee, right, Chris? Is the sum of whichever is the following is greater, the amount paid by the transferee for the property, or the transferor's adjusted basis in the property at the time of the transfer. Okay? And how much did he pay for this? Whichever the following is greater. So Larry, you say what?
Paid 180,000.
Right, didn't he pay the equivalent of 180,000 by taking this property subject to the liability? So here, his basis in this context would be 180. You can't give him a $300,000 basis, or else all that gain would be erased. All right. Remember, gifts generally there's a carryover basis. So normally it'd be 100,000, but in this part sale, part gift context, notice it's the greater of the two. Everyone agree? It's the greater of the two. Let's finish off the problems here before we take a break, okay? So let's keep going and then we'll take a break. Question G. So for your notes, guys, question F, $80,000 gain to the mother here, and the son's basis is $180,000. And we have 2 regulatory sites to get us to that place. What was that? What was your 1001-1, right? 1001-1E for the authority for the first part. Question G, what results in F above if mortgagor gives the land to her spouse rather than to her son? Okay, let's say the same transaction happens in that context, okay? Nina? Gain or loss? And Humera, see if you agree, since you're going to do this on the exam, so you just be the check here. Humera, agree or disagree?
I agree.
Okay, 1041, notwithstanding Code Section 1001C, which says all gain or loss shall be recognized, right? 1041 negates the recognition event here. Everyone agree?
So what was the answer again? I'm sorry.
No gain or loss, 1041. What is spouse's basis in the land? Here, Howard, NECA. What is the spouse's basis in the land? Matt, what is the spouse's basis in the land? And if you say that, why? Markel? What is the spouse's basis in the land? Joyce?
Transfer basis?
Which is how much? What is the spouse who owns the property initially? What's her basis in this property? 100,000, right? That's from question D. And what code section says that the recipient spouse has the same basis as the first spouse? 1041B says treat it as a gift, which takes us to 1015. So the basis here would be the initial $100,000. No leakage here. No gain, no loss. What is spouse's basis in the land? So let's, husband and wife, Martina, you sold this property to Igor, so now Igor has the property, right? Martina, you had no gain or loss here, right? And Igor, for our purposes, is your husband. He gets the property. He pays off the mortgage. Igor, what's your basis now in the property? And Kyle, see if you agree. And Travis, see if you agree with Kyle. What is your basis in this property when you pay off the liability? Kyle, agree or disagree? Think that's right, Travis? Doyle, you're shaking your head. What do you say it is? Because of why? Okay. Do you, now, Travis, agree or disagree? Mike, agree or disagree? Travis? Let me ask you a question, Doyle. Suppose, let's keep the fact pattern real simple. Doyle, this afternoon, you see a great piece of property, say worth $100,000, but you're kind of low on cash. You can't pay for it. Doyle, you see a building, okay? Doyle sees a building he wants to buy for $100,000, has no cash, goes to a bank. Doyle, you acquire the property because Friendly National Bank gives you a loan and you acquire that property. What's your basis in that property? just asking if you go and you see a piece of property worth $100,000, you don't put a dime towards it, but you borrow $100,000 to acquire the property. What's your basis? What's your authority? 10-12. Over the next 20 years, you pay down that liability. What's your basis in the property? It doesn't change. The payment of the liability has no bearing on your basis. Code section 1016 does not speak to any basis adjustment as a result of paying down a liability. Okay? Agreed? All right. We're with me. Just cite 1012 and Crane if you wanted to. The payment of a liability does not cause a basis adjustment. Yes. Carol, go ahead. Liz, I'm saying. Yes. In Igor's hand, it would remain 100,000.
But in 1041E, it has a special thing for the transfers of trust or liability.
There's no trust,
Okay.
so don't worry about that. Doug? 1041B, which takes us to 1015. Okay? Question H. What results to mortgagors under the facts of D above if the land declines in value from 300 to 180? Okay? And mortgagor transfers the land by means of quick claim deed to the bank. So the person essentially says to the bank, here's the deed, have a nice life, onward and forward. So Justin, David, Jenna, any gain or loss here? David, Ying, gain or loss here? Ying? Say again, Ying? Not sure. Sierra? You don't know? Tim, Amanda, gain or loss here? Gain? Tim, agree or disagree?
Agreed.
Agreed? Why, Amanda? What would you cite to as authority? Would that be the right place, Raquel? Matt, would that be the right place? NECA, would that be the right place? Howard, would that be the right place? 1001, but what do you need as help here? We're not talking about basis. Is this a recognition event? If you just give a deed to the mortgagor, does that constitute an amount realized? And you walk away. Nina? Even better is Tufts, right? Because in Tufts, they didn't see a dime, and the liability is considered what? An amount realized, right? When you walk away? Everyone agree? What's the amount realized here? 180. What's the basis? Gain or loss? Gain. Is that recognized? Yes, Code Section 1001C. Now, if the property dips to value below the amount of the liability, if the value of the property now dips to 170, okay? And the amount of the liability is 180. And our basis, if you recall, is 100, okay? Right? It pertains back to problem D. In this case, Liz, any gain or loss? I bet you know more than you think. Arish? Any gain or loss in the last problem? What? Carol? Carol? Yes or no, Carol? What?
Who's the mortgager?
The bank.
Bank? So the land is the bank's now?
The land is going to be the bank's. You walk away from the property. Jing Jing, any gain or loss here?
You said the property now is 170,000?
The fair market value is 170.
I think to the owner is still a gain of 80,000 because he walked away from a liability of 180,000.
Okay, Matt, would you agree?
I think you're moving along because she's correct, but I feel like I do agree because the liability discharge is on.
Yeah, I'm just playing games. She's right.
It makes it so much.
Yeah. Amount realized remains at 180, right, Carol? You walk away from the liability, the amount realized is still 180, right? What's your basis? 100. Gain of 80. What's my authority? Tufts, right? This is the Tufts decision in one sentence. This is exactly what happened in Tufts. The taxpayers in Tufts might have said, oh, we had a $10,000 loss. The court has no patience for that. Yeah, absolutely. You can cite to the regulation because 1001-2 says exactly what I'm saying. So you can cite to the regulation. You're right. I should have cited to the regulation and to Tufts. Both. That's pretty compelling stuff, right? All right. Let's come back here, guys. By that clock, I'm using that clock as my measuring rod. 10 of, okay? You turned it off, or you're coming to get me?
I can turn it off. You can mute it on that, but I'll just turn it off.
To ask if, aside from football games, if anyone did anything interesting this weekend. No movies to report? Not a single? No cultural events? Which? Apple picking. Apple picking is big in New Jersey. Chester?
No, Princeton.
Where? Princeton, okay. This is the time of year, a lot of apple picking. Anything else? No other events? You can't, I read, just so you know, and then you can always test me on this. I'm a big fan, my wife got me into this. Who reads the New York Times on Sunday, the style section? They always have a column called Modern Love. Does anyone read that column? No one? What was that, Travis? Do you read it? All right, so anyway, this one was about how this woman went on her prom date at age 16, and she thought it was going to be great, but it turned out to be mediocre. And so mediocre that she really never spoke to this person after the prom. The prom was too much for obviously both of them to handle. And in this column, she describes how 14 years later, somehow he finds her or she finds him, I forget which happened, and that they had reached a maturity level that enabled them now to finally get married. And that was the take on Modern Love. But it was kind of, I guess there's a bittersweetness to that it took each of them 14 years to finally figure out that this was meant to be. But so don't wait 14 years, I guess, is my takeaway on that column. All right. So periodically, people will share stories like that, and I then circulate it to the class. So if you want, there's one or two others that people over the year that recently people shared with me. But every Sunday, if there's something that akin to that, I can share with you. Question 2. Okay. So question 1, everyone has the different permutations, right? And these are the kind of things that make for good exam questions, so be on your best. Question 2, investor purchased 3 acres of land, each acre worth $100,000 for $300,000. Investor sold one of the acres in land in year 1 for $140,000, second in year 2 for $160,000. The total amount realized was $300,000. So the investor here would like to report how much? The investor in problem 2 would like to report how much? The investor would like to report 0, right? 300 less 300 less I checked is 0, right? Does the code permit the taxpayer to report 0? No. What do you think the code does? What do you think if you had a moment to look at the regulations that the authors cite you to that your client will never be so kind to do? To split it, right? You bought each acre for $100,000. Isn't that your basis? $100,000 a piece, right? And if you did, okay, what's your amount realized on acre 1? 140, gain of 40. What's your gain on acre 2? Did you sell it for 160? Your gain on acre 2 would be 60, and the third acre whenever you sell it. So you can't front load your basis, right? This regulation, the authors cite you to 61-6A, says you have to take into account your basis in a piecemeal fashion, which makes sense, right? Everyone agree? Nothing complicated about that, right? Question 3? Question 3. Gainer acquired an apartment in a condo complex by inter-vivos gift from relative, right? What code sections are going through your head after you read that first sentence? You're thinking code sections, right, Emmanuel? You're thinking code sections. What code sections come to mind? When you just read that first sentence, there's code sections, your neurons are firing in your brain, right? Emmanuel, what code sections are going off? Excuse me? Question 3. Jeff, what neurons are firing? This is question 3. Gainer acquired an apartment in a condo complex by inter-vivos gifts from relative. What code sections are you thinking about? 102 is 1, right? You're thinking 102. What else are you thinking about, Mikey? No one's dead. Gary? What? 1015, right? Right? Now look, no one knows where it's going, but again, as practitioners, you guys will hopefully think about these code sections, right? Because it helps you orient yourself. You don't know where the client's going, but at least initially, your brain's on the roll. You should be very proactive when people are, they're paying you $400 or $500 an hour, hopefully. You better listen carefully, right? You don't want to say, if you don't mind me saying so, repeat that, all right? Once in a while, it's so important, you'll say repeat that, but at a certain point, clients are going to become irritated thinking, gee, this person just wants to bill me for more time, all right? So just be sensitive to the fact you better be very good listeners to your clients. And what is crucial, in my opinion, when you write, whether it be for your supervisor or client, what is the first thing you start with when you write an opinion letter to a client? What's the way you start an opinion letter to a client, Larry? Your conclusion? What else might you start with, guys? How would you start an opinion letter, or a supervisor asks you a question? What might be the best way to start that as you're sitting down to type an answer and your supervisor wants to make sure you know what you're doing? What's the best way to start that? The facts. And you might say, there's another symptom of someone feather bedding their bill, because you're writing facts, and why are you writing facts? Isn't the client just going to say, you're just trying to make a longer memo? We all know the facts. And what could be less true than that, right? How many times have you said one thing and someone totally misinterprets what you said? And I'll give you a quick example, but in this room I'm sure we all have examples. I remember when I was building a house many years ago, and there's an excitement when you build a house, like it gets framed. And there was a person who had already moved in, and I called that person up and I said, I came up, and it's not around the corner where I live, it's up in Randolph, and I said to the neighbor who had already moved in, is it worthwhile for me to come back out because has the second story been framed? All right? simple question. And she said, oh yeah, the second story has been framed. All right? Second story has been framed. So what I do, raced up there, hit all this traffic, and I get there. And what was there to greet me? Was the second story framed? What was there was the second floor was framed, meaning there was no actual second story framed, but the floor itself was framed. It was complete miscommunication. It was such a waste of time on my part. The point I'm making, and I don't know if that worked for you, but we can all imagine, and time and time again, I have written what I'll call a fact pattern to, when I was an associate, to the supervisor or to clients, and people will say, oh, you misunderstood what I said. It's this. And the point I'm making with you is that, or trying to make, is that the facts are so crucial that you're going to have decisions made, and if you don't have a common understanding of what the facts are, it's a recipe for disaster. And that's another thing that you got to be careful about, is that if you just write it's non-taxable and you don't write on the basis upon which you're deciding, clients will take that non-taxable email and run with it, and if there's a problem down the road, they'll blame you. So what you have to do, guys, when you write fact patterns, when you write memos to your supervisor or to your clients, always write down the facts, because you will be surprised, I don't want to exaggerate this, 30 to 40% of the time, someone's going to come back and say, that's not the fact, and your analysis may be changed in some critical way, all right? So don't just, if you don't mind me saying, Larry, start with a conclusion, or start with the issue, and just assume away that everyone knows we're dealing with the same facts. Write out whatever you think the facts are, and that's not a way to feather bed your bill, okay? That's a way to make sure that everyone starts from the same position, or else, again, recipe for disaster. Both use it only as a residence. It has been purchased by a relative for $200,000 cash. So your brain is, as always, thinking code sections, right? So in this case, Ying, what code section comes to mind as you read that next sentence? You read it. It's been purchased by a relative for $200,000 cash. Ying, what code section? 1012, right? You're thinking basis. By the way, Ying, say it louder. Right? How much? Ying, what's the basis? Is that the loudest you can say it? What's your authority? All right, 1012. It was given to Gaynor when it was worth $300,000. Everyone have that? Fair market value is $300,000. Relative paid $60,000 of gift tax on the transfer. Gaynor later sells the apartment to Shelter. Okay? So, relative gives the property to Gaynor, who sells it to Shelter. Okay? And it's bought for $200,000, fair market value of $300,000. What gain or loss to Gaynor on the sale to Shelter for $320,000? Okay? What is the amount realized here? In this case, Bill, what's the amount realized? Gary, agree, disagree?
Agree.
Okay, the amount realized here is $320,000, right? What is the tax basis, right? Because we're applying code section when you hear there's a sale. What code section comes to mind? When you hear there's a sale, what code section? 1001, right? That's where your brain is firing. 1001. What is the gain or loss here? Al, Patty, Ran, what's the gain or loss here? Give me a number. Go for it, Patty. Raquel, you hear that? Did you hear that, Raquel? Did you hear that? Barely. Patty, can you say it louder, please? Why? Say it loudly. What's the basis in your opinion? Say 300. So you say gain of 20. All right, Ran. Al, agree or disagree? You agree? Who said it? Al, you agree? Ran, agree? $220. Okay, so you say, no, this is messed up. It's 320 less 220, and the gain here is 100, right? Did I say that correctly? Ling, you agree? Disagree? You have a bunch of different answers. Topeka? Both, either of you? You disagree? So what do you say it is?
The basis is 260,000.
So you say it's 260. And gain or loss? Wow, we got a whole bunch of answers. Ron?
Where did that 220 come from?
We'll see in a moment. We'll see in a moment. Okay, hold your. We'll see if if Ling nailed this. Doug, you agree? What do you say it is? You say it's what? Well, let's take a show of hands. How many people say it's 20? Please don't fence it. Have an opinion. One of these three answers. Anyone say it's 20? No, not much support for that. 100? Few hands. Who says 60? Okay. Matt, why do you say it's 60? What's your authority?
I really don't think it's 20 or 100.
Well, I don't know if we want to do that for a client.
I don't know where the 220 came from in the second scenario.
Okay. Go ahead.
I don't know if I did my math right, but I think the 220 comes from 1015 D6.
Oh, hold on. A lot of people use 1015 D1, right? What do we know about 1015 D1? That's, if you use 1015 D1, you'll be sued this afternoon. Because what is it about 1015 D1? It's been out of date for about a quarter of a century. All right? So you don't want to cite to code section 1015 D1, do you? Anyone here want to do that? I don't think so. And what does 1015 D6 say? What is the adjusted basis if there's any gift tax paid? What's it say? What's our starting point under 1015? It's a ratio, right? It says what? It says the increase in basis provided with respect to any gift for the gift tax paid under Chapter 12 shall be an amount which bears the same ratio as the amount of tax so paid. How much tax was paid here? By the way, what's your starting point? What's the starting point when there's a gift? What's your starting point for your tax basis in that property? How much? What's our starting point? The transfers basis under what code section?
1014.
No one's dead. 1015, right? Isn't it 200,000 plus 1015 D6 says there's an adjustment, right? Everyone agree? 1015 D6 says there's an adjustment. What's our starting point? D6 says the starting point is the amount of gift tax paid. How much was the gift tax paid? Okay. Times what? The net appreciation of the gift. How much had the gift appreciated in the hands of relative? It went up from 200 to 300. Everyone agree? Went from 200 to 300 in relatives' hands, right? The appreciation is 100 over the amount of the gift. What's the amount of the gift here? 300,000. This is equal to 20. The basis is equal to how much? Ron, you happy? 220. Isn't this what code section 1015 D6 says? It says take the amount of gift tax, times it by a numerator, the amount of the appreciation in the property, which is 100,000, over the amount of the gift. That's the tricky part. So in this case, Ling, you said, right? This was your answer, right? Topeka said it. All right? Perfect. The basis here is 220. What? Oh, you said the wrong. I thought, Ling, you said the right. Oh, I'm sorry. Ran, you nailed it. Good job. Great job. All right? Thank you, Ran. All right? Patty, you still look confused. Patty, you got this? Yeah. Okay, I just want to make sure.
Where does it say how to calculate it?
Look at 1015 D6. It says take the amount of gift tax paid. Now, look, admittedly, Igor, is this the easiest thing in the world to read? No, absolutely. If I said this was a piece of cake, I'd be lying through my teeth, right? But what people like myself, and hopefully you guys would do, is we look at commentary on how to interpret this, okay? And people will write treatises, and there's there's all sorts of resources to take code sections as practitioners and say, what does that really mean? And there's plenty of resources available. But if you read the actual language and think about it, it says, take the amount of gift tax paid times a ratio, the numerator of which is the appreciation, the denominator is the amount of the gift. That's it. And there's under code section 1015 D6, not 1015 D1. That's been out of date for over 25, 35 years now. So you don't just increase it by the amount of gift tax paid, right, guys? This is old law. So if you told your client to report this when the answer should have been this, they will interest and penalties on $40,000. Add a few more zeros, they could owe interest and penalties on $40 million. And guess who they're going to come after if you give them the wrong information? Are they just going to say, oh, everyone's entitled to an off day? Nope. Everyone have this. Last question. What is shelter's basis in the apartment? What is shelter's basis in the apartment? Joe? You not sure? And you got to get can't put it away, Shangnan. What do you say it is? What is shelter's basis? Matt? It's Matt, right?
Yeah.
Raquel says it's 320. What's your authority? 1012. 320, right? Joe, it's not a trick question. This is what shelter paid for, right? 320, right? These are the easy points on an exam. The harder points are, the basis issues and things like that. So, Zen, you got this?
No.
What's the problem?
I think the basis should be the cost of property he received, not what he paid.
Isn't that one and the same? What's your basis in property? How much did he pay for this?
It's not it's for 300,000.
No, that's not what it said. That's when the gift was made. It said that in question A, it says it was sold for 320. Ah, big difference. Okay? Read it carefully. Final question, question C. Question 3C. Same questions now, assuming relative acquired the property for $80,000 in cash, but subject to a liability of $120, on which neither she nor Gaynor was ever personally liable. So it's a non-recourse liability. Okay? And that relative paid $30,000 tax on the gift. Upon purchase, Shelter merely took the property subject to the mortgage, paying $200,000 cash for it. So in this problem, it's the same, except now the relative acquired the property for $80,000 of cash. So initially, the relative acquired it for $80,000 of cash, subject to a $120,000 liability, right? What is relative's basis when relative Jing Jing acquires this property? What is relative's basis in this property?
200,000.
200,000. And where's Jing? Yeah, Jing. I got it. Jing, do you agree or disagree? What's your authority? 10-12, right, Jing? 10-12. Okay? Let's keep reading here. And now, relative gifts it, and Gaynor, the recipient, sells it. Jing, any gain or loss here? Let me ask you a different question. What's the amount realized here? What's the amount realized? How much do you say it is, the amount realized? 300, Jing says. Akash. Arkesh. You can never say it right. I apologize. Arkesh. Arash. I can't do it. Arash. Keep trying to say it. Arash.
What's your question?
What's the amount realized? And Carol, see if you agree. And Doyle. How much? Relative, because Shelter is owning property. There's no amount realized to Shelter. 300.
Yeah, I agree.
Liz, Carol, Doyle, do you agree or disagree? How much? You say the amount realized is 200 to the relative. I'm actually talking about, the gainer. Remember, relative's giving a gift, right? What's relative's basis in this property? What did we decide it was? 200,000. When relative gives this property to gainer, you might say it's a part sale, part gift, right? But remember, what's the liability here? 120. And what do we know about part sale, part gift under Regulation 101-1? If the liability, in this case, the amount realized is going to be less than the basis, is there any loss recognized when relative gives this part sale, part gift? No loss is allowed. Okay, now gainer turns around and sells it, right? What is gainer's amount realized? Say again? How'd you get it? Hold on, let's slow down. He's getting $120,000 of cash, right? Everyone agree? Last I checked, that's certainly part of your amount realized, right? Everyone agree? Gainer's going to see 120 cold ones or hot ones or whatever you want to call it, right? And what else? Oh, I'm sorry, 200 in cash, I apologize, 200 in cash, and what? Oh, okay, and we know under 101-2, what else is considered part of the amount realized? The liability, right? So the amount realized here to gainers, how much? 320, okay? So in this problem, just like in the other problem, the amount realized, everyone, this is important, is 320, okay? Everyone agree? This is not a trick question. The amount realized here is 320. Code section 1001B combined with the regulations, combined with Crane. The amount realized here is the person's getting 200,000 in cash plus liability relief of 120, right? 320. What's the harder issue here? What is the tax basis, right? What is the tax basis when gainer sells this property to shelter, right? John, Emmanuel, Jeff, what do you guys say the basis here is? Come up with a number. Jeanette? Numbers. Give me a number. Here are a bunch of different numbers. 210? What's our starting point? 200, right? Plus how much? Where'd you get that from? So what does it come out to be? 210? Now, can anyone say that's wrong? Is there any better answer you can come up with? We're done. How much is the appreciation in this property? In this problem? Same 100. Everyone agree? Everyone agree? It's 100,000. What is the amount of the gift? Pretty. What's the amount of the gift? How much? If I gave you this gift, how rich would you feel? If I'm relative, I give you this gift. Pretty. I give you this gift. How rich do you feel? What is the amount of the gift? Isn't it more like 180 than 300? Because, look, Pretty would be happy if she got this gift, right? You would be, right? No doubt. But wouldn't you be happier under the first scenario where there's no mortgage on this property versus the second scenario? Yes or no? You much rather get this property not subject to a liability than subject to a liability, right? What is the real amount of the gift? Wouldn't it be 180 here? Right? Couldn't you make an argument that it'd be 180? And if that were the case, what would happen to your basis here? Wouldn't your basis go up? Is that good or bad if your basis goes up, guys? No, it's good. The larger the basis you have, the smaller the gain or the larger the loss. Basis is good, right? Won't that produce a smaller overall gain here? Anyone have their calculators out? What's the gain here? No one's going to help me out? 103, 333. Isn't that a better result than if this were 210? Then you would have $110,000 worth of gain, right? So isn't this a better result? Everyone see? We just, by changing the amount of the gift, which is a better answer, we saved our taxpayer lots of money. Right? Doug? All right, say again? Yeah. Yep. Because the code under 1015D6 says the denominator shall be the amount of the gift, right? Well, when Pretty got this gift, she was happy, but she wasn't as happy would she have gotten the gift, and there's no liability. So I think it's a fair reading of the code to say her gift is really 180 and not 300, right? Questions? Now, guys, when we leave here, when I say leave, this chapter deals with computing gains and losses, right? And this comes up in practice all the time, right? People are going to constantly talk to you about the sale or disposition of property. Just that's the nature of a commercial world. Lots of sales and exchanges, right? So you will have to, on a regular basis, compute gains and losses under Code Section 1001 and numerically come up with the right answer, right? What is the amount realized? What is the adjusted basis? And numerically come up with the gain or loss. That's what this whole chapter is about. We're about to jump ahead. Now, you can tell if I were the authors of this book, I think the next natural thing to discuss is what is the character of this income, because that's going to have an important bearing on the tax implications. So if you recall, we jumped to chapter 21. Before we jump, because we like to do this hand in hand, any questions regarding chapters 1 through 4 and chapter 6? Any lingering issues? MJ?
So, according to like every single mortgage, if like under law, is like taking the mortgage and first tucking.
What is your question? I'm not sure.
So, like Freedom Commission sets a precedent for like a lot of mortgages that are like underwater today.
There's a lot of mortgages that are underwater, but notwithstanding the fact that they're underwater, what would end up happening is if there's a discharge of indebtedness, do you have income? Let me just ask you, if someone discharges your liability, do you have income? Yes. Code Section 61 says if you borrow $100,000 and the lender subsequently says you only need to pay back $60,000, you have income of $40,000. Okay? Congress, until the end of this year, to try to take away some of the bite of people who are underwater regarding their liabilities pertaining to their home, has said that forgiveness of debt, as it pertains to your primary residence, does not constitute income. Right? So there is, Congress actually has fashioned debt relief in this context with respect to home purchases. Any other questions? Deepika? Yeah, I would say to 1015D6 for that proposition. Other questions? Go ahead, Tim.
For 1I, what did we say the answer for that was?
I turned the page. What is?
Page 159, question 1I, what will the mortgager when you apply to the age above if the loan declines?
It's the same outcome. Same outcome. Any other questions? All right, we're good? All right, that's what I want to hear. Chapter 21, capital gains and losses. There is a lot of discussion, need I say more, about what's going on politically, right? About Romney's tax returns and about our country and about capital gains and how capital gains are taxed, right? Everyone, I mean, unless you put your head in the sand, and you never look at the newspaper, you never look at Yahoo News or wherever your news source is, everyone can see there's a lot of discussion right now, right, about capital gains and losses, right? And one of the questions you should be asking yourselves, I hope, is should there be capital gains and losses? Are capital gains, for example, given preferential treatment? And the answer is, Annie, do you know? Annie, do you know capital gains or losses? Preferential treatment? I'm sorry? Are they, do you rather have ordinary income or capital gains? Why? It's what? What's the difference?
Because it not, the depreciation is occurred in a long period and recognized when you
All right, but from a taxpayer's perspective, what benefit is it to have capital gains? What? Say again? Lower tax rates, right? Lower tax rates. What's your authority for the lower tax rates? What code section? 1H. Code section 1H. And for our purposes, guys, on an exam, you should bring your calculator, but we're not going to have heavy-duty computations. Why? In my opinion, that's a waste of your time and energy in our class. Why? Because who does the computing when push comes to shove? The computer, right? Do you sit there and compute the actual capital gains and losses? The answer is no. No one I know sits there and actually does the number crunching. At some point, you have to trust your computer, or else you're never going to be cost efficient, particularly with a reputable software company. So we're not on an exam. Am I going to say compute the taxpayer's actual tax liability? Because again, that's not going to serve anyone well. Now, with respect to, by the way, I thought I shut off my phone, but I think it's going off, so I will apologize. With respect to capital gains, there is this preferential rate. What is the highest income tax rate? 35%, right? Code section 1. Everyone agree? Code section 1, the highest marginal tax rate is 35%. Again, Governor Romney last night in 60 Minutes said wants to cut rates across the board by 20%. Now, and he said simultaneously, though, that he wants everyone to essentially pay the same amount. Like if you're in the upper 1%, you would still pay the same tax liability, but you would have a lower tax rate. And why? How can you perform that feat of magic? Let's say again? Broaden the tax base, right? Now, what he doesn't want to say, which is reality, is the only way to get where he wants to be is you got to eliminate things like the charitable deduction, you got to eliminate home mortgage deductions, things like that, which I'm not averse to. I don't think that's necessarily a bad thing. I'm not quite sure why homes, the interest on homes should be deductible. So that's my own 2 cents. So I don't think he's misguided in saying that, and probably reducing tax rates and broadening the tax base is a good thing, but there's some other things I might consider where I came for the day. But the point is, capital gains are taxed at a highest rate of 15%. There is an exception with respect to so-called collectibles. Collectibles are taxable at 28%. And there are, if you're low income, capital gains can be taxed as low as 0%, okay? Now, for your client base, generally that ain't going to apply. Let me just say that at a very low threshold, it's going to be subject to income threshold. Your client base is generally going to be subject to 15% capital gains rates, all right? Let me just state that. And for our exam purposes, we're going to assume 2 rates for capital gains, 15% for long-term capital gains and 28%. And I come back to, and I still say, should capital gains have a preferential rate? And what are the reasons given for preferential rate? Larry? Encourage investment. Justin? Larry?
Double taxation. Corporate tax.
A double taxation because the earnings are already taxed once. Kyle?
Say it's not like an actual gain if you're never investing in something, you're not actually seeing.
I mean, you could say, I mean, it really depends. I mean, some people don't take the proceeds and reinvest, so I'm not so sure. Isn't there this concept of, go ahead, Matt?
It's also that the gains could have been realized over a period of time, and therefore it's
Bunching, right? You know, if in a progressive rate structure, maybe the income, you bought Apple stock at $10 10 years ago, and now 10 years later it's worth 100. So you're telegraphing all $90 worth of gain in 1 year, jumping you up the marginal tax rates, right? There's also this so-called lock-in effect, right? Where if you have Apple stock that you bought at $10 is now worth 100, and you think there's a better investment to be made that's going to produce higher returns, you might not sell that Apple stock because on an after-tax basis, even though there's another investment that produces a higher return, let's say the tax rate were 90%, and you have $90 worth of gain, okay? So you're going to lose about $81, leaving you with only $19. Did I do that right? Yes, because you had a $90 tax rate, $90 worth of gain, $81 worth of tax. So yeah, you have your original $10 basis. There would be $19 left. Even if you saw Dell was going to give you a much better return after tax, you might say, I'm not going to invest in Dell because Apple, I'd rather have $100 working for me with Apple, even though it's producing less, than to sell my Apple stock, only receive net proceeds of $19 after tax. Even if Dell is giving me double my return, I can't possibly make more money, so I'm locked in. I got to stick with Apple, okay? Now, let me just ask you by a show of hands, and again, let's not fence it. How many of you subscribe to the notion there should be preferential capital gains rate? And then just ahead of time, the other question, people say that capital gains should not be given a rate preference. So how many of you say capital gains should be given a rate preference? Hold them high. No one should be bashful. We're amongst friends here, okay? I'm just trying to get a sense. How many say tax at the same rate? So, okay. And in fairness, I'm amongst friends, right? At least I think I am. I better be careful. Check my tires and brakes before I go home tonight. I myself am not a believer in preferential capital gains. And I'll state my reasons, and we can debate this, and you can send me nasty emails or nice emails, sugar-coated. Here's my thought, or thoughts I'll share with you, is that when someone like Bill Gates, the entrepreneurs of the world, and Steve Jobs, it's in my opinion, their DNA, okay? They're going to make investments because they think they have a brilliant idea. I don't think they check the capital gains rates and say, you know, I think I'll go play tennis today instead of trying to invent Microsoft, okay? I think that, or I'm going to invent the iPhone. I don't think people are driven by capital gains rates in terms of their investments, in terms of spurring the economy on. That's my own thought. Secondly, in terms of the bunching argument, how many people, for example, take the attorney who has a contingency case, medical malpractice case, that works 5 years trying to put together a compelling case that this doctor committed malpractice and therefore earns $1 million after the case. There's a jury award after 5 years, and the jury awards $3 million, and the lawyer makes $1 million, all pigeonholed after 5 years worth of work in 1 year. Does that person have bunching of income? Do we give them relief, income averaging over those 5 years? No. They have the same experience as just the labor is telegraphed in 1 year, just like capital gains might be telegraphed in 1 year. The most, I'll say, a legitimate argument possibly is that this lock-in effect where people might be discouraged in making investments in more productive assets. That may be true. I'm not so sure, though, in my example, if there might not be other investors in Dell who make up for the shortfall. The fact that you have less liquidity because on an after-tax basis it doesn't make sense for you to invest in Dell, I'm not sure if that's enough to justify saying that there should be a preferential capital gains rate. So, and let me just say this for whatever it's worth, that in 1986, when Ronald Reagan flattened the tax rates, the flat rate was 28%. Capital gains and ordinary income were taxed at 28% until George Bush Sr. came into office, and there was a slight difference. But for many years, for at least a half a decade, capital gains and ordinary income were taxed at the same rate. Did the world stop? Did commerce stop? Did investment stop? Did the entrepreneurs just hang it up and play tennis? So I ask, for those who are subscribers to this preferential rate, you take it on, I think a lot of people just take it on faith. It's a religion. We have to have preferential rates for capital gains. How much complexity in the code do you think is attributable to capital gains versus ordinary income? A lot. A lot of the complexity of the code is based on this differential because there's such a difference in the rates. A lot of taxpayers are paying people like us to formulate carried interest, okay? Where instead of being taxed at normal tax rates, if you're, again, Romney and you earn money, he was able to get it through at 15 on his labor, was able to classify it as capital gains and be taxed at 15%. So there's a lot of people being paid lots of money to transform what might be ordinary income into capital gains. So again, before you just say it's got to be as an article of faith, say that for religion, in my opinion, not when it comes to the code. But that's my 2 cents, and again, you can disagree with me on that. That's fine. A lot of people apparently do in the country. But just keep in mind there's a high cost to administrability, right? One of the key features by having this rate differential. So as you're reading through this stuff, you should bear that in mind. Capital losses. With respect to capital losses, can you take your capital losses whenever you wish? Can you take capital losses whenever you wish? No. Why not? There's a code section, but what's the policy objective against taking capital losses willy-nilly whenever you please? And you look on page 717. The authors give you some legislative history here. If you see, at the very top it says on page 717, the page at the very top, take for example in the case of a man with an income of $350 per year, assume that he bought in that year 1917 5,000 shares of X, and that he sells the shares in 1922 for $600,000, showing a profit of $100,000. By reason of this transaction, in addition to paying his regular income tax, he would pay $12,500. Okay, big rate preference. But assume instead of selling the stock at a profit, he sold it in 1922 at a loss of $100,000. He would then be able to deduct the $100,000 for his income of $350,000, and the loss to the government by reason of the deduction would be $58,000. So this taxpayer was presumably at the 58% marginal tax rate on ordinary income. Is there any further argument needed? Meaning, taxpayers willy-nilly can choose when they take their capital losses, right? Do you have that option when it comes to ordinary income? No. There's no latitude. Generally, there's very little latitude when it comes to ordinary income. And if you could strategically time your capital losses, what would you do? You would take capital gains in one year and get the rate preference. And what would you do with your capital losses? You would never take them in the same year. You would always take your capital losses against ordinary income, right? Because if your ordinary income is taxed at 35% and capital gains taxed at 15%, you would make sure certain years you had capital gains, get that rate preference of 15%. In other years, you would flip it and use your capital losses strictly against ordinary income and shelter income at 35%, right? That's what we would be doing all the time as practitioners. And there's a code section that says you can't do that. Okay, what code section is that? 1211. Okay? So if you want to open up to Code Section 1211, it tells you that capital losses are limited. Limitation on capital losses. Can individuals take any of their capital losses? Doug? How much? 3,000 if you're married, 1,500 if you're single. Corporations, can they take their capital losses? No. Now, do the capital losses get wasted? Or they just, if you can't use them, do you lose them? No. What happens, Amanda? You carry them over. What's your authority? It doesn't say 1212, right? 1212 carries them over. What about with respect to corporations? What happens to corporations in terms of their capital losses? They are able to carry them back 3 years and carry them forward 5 years. Individuals can only carry them forward. Corporations can carry back 3 years and then carry forward 5 years with respect to their capital losses. Right? There's carry back, carry forward. Suppose you have major capital losses, let's say $1 million, and every year you carry them forward and periodically using them against your capital gains. And then, like most things, or can happen, what happens when you die with your capital losses? They die with you. Poof, they disappear. So at death, capital losses disappear. Okay? You can't, I mean, maybe you say you can. You do take them to the grave with you. Okay? Go ahead, Bob. It just says carry them forward, and it's silent. Okay? Which means there's nothing that permits any beneficiaries of your estate to get them. And the reason this is true, Larry, is under Code Section 1014, which gives you basis equal to fair market value. The quid pro quo for that is the fact that capital losses shouldn't be allowed to be carried forward. Those are all capital related, so they're somewhat related. Okay? So capital gains and capital losses, for our purposes, guys, there is. I mean, notwithstanding what I say, which is, for our purposes, pretty worthless in the context of the code, there are preferential rates, and given what I see in Congress, that they're not going away quickly. I mean, if Romney were elected president, and if he really wants to adhere to this notion of keeping or reducing the marginal tax rates, which, again, you can hear I'm a big fan of, I think it's a good thing, I think he has to raise capital gains rates, because otherwise it will never be revenue neutral, and he will never, he said, he would want the top income earners to pay the same amount they're paying already. He said he's not looking to reduce taxes on those earning more. The only way to accomplish that goal is to raise the capital gains rates. I just can't see that happening under his administration, but I could be wrong. But I think in other words, if he wants to achieve his objective of being revenue neutral, that's the only way to do it. Okay, beginning on page 718, the authors describe how to compute capital gains and losses. And this is spelled out in Code Section 1222. Okay, 1222 describes what is a short-term capital gain, what is a short-term capital loss, long-term capital gain, long-term capital loss. What is a long-term capital gain? Okay, you must hold the capital asset for more than 1 year. Has that always been the case? No. Okay, that 1 year benchmark is not been around since, the advent of capital gain preferential rates back in the 1920s. So periodically you may see mention to a 6-month capital gain rate, because some points in our country's history the long-term capital gains used to be 6 months. Other times it's been more than 2 years. Sometimes during the Depression, they actually tried to structure the capital gains rates so that if you held it for, say, 2 years, it would be something. If you held it for 3 years, it would be less. 4 years less, 5 years less, this notion of bunching, like each year you would have a lower, but that didn't fly. My point is this has not been a universal truth that every year it's always more than 1 year. Right now, 2012, it's more than 1 year. You get this preferential rate. Do corporations get this preferential rate? Do corporations pay a reduced capital gains rates, Guy? Many of you are shaking your head no. Why not? Not because. Why? Someone else? Raquel, do you say? Matt, you said? Do corporations... Go ahead, Mike. Where are you looking? What code section? 1201. But that, Mike, you're looking probably at an older code. What code? What do you have your code there? All right. Because what's the high? What rate are corporations taxed at? What rates are corporations taxed at, guys? I hear different numbers. If someone said 35, what's your authority? What? No. But how are corporations ordinarily taxed? What tax rate? Last I checked, they're not married. What's the taxing code section for corporations, guys? Code section 11. Code section 11 is the tax rate. What's the highest corporate tax rate? 35%. Everyone agree? And what does code section 1201 then say? Code section 1201 says essentially corporations shall not be taxed at a rate less than section 11 when it comes to capital gains, right? So corporations on their capital gains are taxed at what rate? 35%, right? Now my question to you is, having said that, do corporations care if they have capital gains versus ordinary income as a result? Joe, do they care? Do they care if corporations, do they care if they have capital gains or ordinary income? They care, you're saying. So you say they care, they'd rather have capital gains. Why? But that's not a good answer. Why not? I mean, you got to have a reason. So, do they care? Pretty? Do they care?
Yeah, according to 12,
12. What? There is a code section 1202 that deals with small business corporations, but ignore that. In general, do corporations care if they have capital gains or ordinary income? In general. They couldn't care. Justin, you say they couldn't care less. They couldn't care. Larry, you agree? They don't care. Anyone say they care? So you're saying that corporations couldn't care less? Yeah, they care a lot. If they don't have capital gains, they can't use their capital losses. So when in doubt, corporations much prefer capital gains. Right, Joe? Even though there's no rate difference, they want capital gains. Why? Because then they can use their capital losses. If they simply have ordinary income, their capital losses are going to sit there and not be able to be used, right? Everyone agree? Corporations do want capital gains. Why? Because that enables them to use their capital losses. Agreed?
Since it's all the same rate, wouldn't the
you can't use the capital losses. You can't use them. So even if you have $100,000 worth of income and $30,000 in capital losses, you don't net 70. You just get taxed on 100. But suppose instead of having $100,000 of ordinary income, you had $70,000 of ordinary and $30,000 of capital gains. What would happen to your capital losses then? They would reduce the capital gains. You'd only be taxed on 70. Wouldn't the corporation much prefer to have capital gains? Yes. Okay? Now, on page 725, let's just quickly go through this, and then I want to tell a quick story, so don't go anywhere. Problem 1 on page 725. Taxpayer has a salary of $50 in the current year prior to 2013. Also has the following transactions: gain of $15 on the collectible and a gain of $20,000 to the stock held for more than 15 months. Determine the amount of T's net capital gain. Well, that's easy enough. That's 15 plus 20. The last I checked is 35. Okay? At what rate will the components of T's net capital gain be taxed? Well, I told you, collectibles at 28% and the stock at 15%. Question 1C, do not worry about. We're not going to cover. Okay, I'm not going to have anyone compute the actual tax. Question 2, taxpayer who's in the highest federal tax bracket in the current year has $5,000 of gain from a collectible, $5,000 gain from stock, both held long term. Okay, everyone agree? Gain from a collectible, gain from stock. What is taxpayer's net capital gain, and how is it taxed if taxpayer also has a $5,000 loss for a collectible? Well, you net the two, meaning the collectible against the collectible. You're going to end up for your notes, Caitlin, you got this? $5,000 taxable at 15%. All right? So you're going to net the common categories, right? Question 2B, what result in A above if instead taxpayer's $5,000 loss is from stock held for long term? Well, you're going to net common categories, and what's going to leave you? $5,000 taxable at 28%, right? What result in A above if instead taxpayer $5,000 loss is from stock held for 9 months, that's short-term capital gain, rather than from the collectible? Now, we don't know. This is from a different category. This is from a category short-term capital gain, this short-term capital loss. And if you look on page 723, and if you look at footnotes 37 and 38, you can review footnotes 37 and 38. It produces a tax-friendly outcome, meaning you can net that $5,000 loss against the collectible, leaving $5,000 taxable at 15% for your notes. Okay? We'll pick up, when we come back, we'll pick up on this, but I want to complete this and then ask one more question of everyone. So don't leave me. Question 2D. What result of taxpayer's net capital gain? What is taxpayer's net capital gain, and how is it taxed if taxpayer has $5,000 gain from a collectible, $5,000 was called unrecaptured 1250 gain. 1250 gain, we'll learn, guys, is taxable at 25%. So just put that in the margin of your notes, that unrecaptured section 1250 gain, taxable at 25%, and $5,000 gain from stock, and $10,000 loss from stock, all held long term. Okay, so you have $5,000 gain from a collectible, $5,000 gain from unrecaptured 1250 gain, and $5,000 gain from stock. The collectible is normally taxed at 28%. The unreported recapture gain taxable at 25%. $5,000 gain from stock is taxable at 15%. Now we have $10,000 loss from stock, all held long term. And what we'll see in this instance is the $10,000 can be netted against the stock because that's a common class, and then against the collectible because the collectible is taxed at the next highest rate of 28%, leaving $5,000 taxable at 25%. What's my authority? I would rely upon the footnotes I specified on the prior pages, the material on page 723 for the proposition that you can use a pro-taxpayer netting. So in this particular case, we're using the $10,000 loss from the stock against the same class And then we're allowed, because it's written in a pro-taxpayer fashion, to use it against the highest capital gains tax rate of 28%. Larry?
What's the numbers for this?
I'm sorry, footnotes 37 and 38 in the textbook. Now, let me close by mentioning two things. Capital assets. What is a capital asset? Because isn't this entire thing turned on capital assets, guys? Everyone agree? This whole thing turns on capital assets, right? What is a capital asset? Everyone think they know? Where do you look? 1221, which is entitled Capital Asset Defined. Now, I will leave you with a question, and we'll pick up on this question for next Monday. I read, if you go Google this, about 10 years ago in the New York Times, front page, about women at St. Barnabas Hospital. Everyone know where St. Barnabas Hospital is? Unfortunately, if you ever become a burn victim in New Jersey, that's where they will helicopter you to. It's in Livingston. And what was the article about 10 years ago on the front page of the New York Times? How women were selling their eggs to infertility clinics for $5,000 a shot. Now, that made for interesting reading, right? But when I read that, what do you think I was thinking about? I want to know about the tax implications. So ask yourself, women and men, your eggs, your sperm, how would you tax the sale or disposition? All right, so think about that. We'll bring that up on Monday. Guys, by the way, for your next class, I hear you're already asking, that's a fair question. If you could, for next class, read up to, I don't know exactly, we'll certainly get to page 766, but if you don't want, read up to page 775, okay? Up to 775, okay? For next class. Let me give this to you.